Yeah, Marty, thanks for putting this together. By way of introduction, my name is Misha Vasilchikov. I'm a founding partner here at ARGO Capital Advisors. We're a team of three based in New York. I was FINRA registered. Started my career on the heels of a recession back in 2008, and so the most sort of the core of my professional experience has been focused on mostly lower middle market M&A, private companies, oftentimes family-owned businesses, 2 to 15 million of EBITDA. Co-founded Argo in January 2020, so another interesting time to start a business. And today our practice covers four kind of legs. One is M&A, two is primary capital raises across Series B plus companies, as well as growth equity rounds. Secondary transactions where we make a market on an agency basis for early investors, family offices, asset managers, VCs. And help them get access to hard to get names, be it SpaceX or battery farming and so forth. And really the last piece of our business is fund placement. So that's really it in a quick nutshell.
And just to clarify, those secondaries are private market secondaries, right?
Correct. Yeah. So there's generally two. So if for those that are not familiar with secondaries, that or maybe you've heard the term used in the past, historically, 10 years ago, when you hear the word secondaries, it would really generally be related to fund secondaries. Today, what's sort of happening, sort of the macro perspective is that there are over 1,000 companies that are valued at over $1 billion or more. And especially now as the IPO market and the SPAC market is drying up, and look at the IPO ETF is down, I believe, 49% over the last year, and so there just becomes an even bigger market for private company secondaries, and that's really where we spent a lot of our time and had a lot of success doing that last year.
So you're saying there's 1,000+ unicorns out there in the private markets. And are these typically later stage companies that you're
I mean, they're obviously the typical suspects, the GoPuffs of the world, the SpaceXs of the world, the ByteDances of the world, right? But these are mega companies, right? We're talking not just $1 billion in valuation, we're talking 100 plus, right? ByteDance, a month ago was trading in the 350 billion dollar valuation range. Stripe, bounds between 150 to almost 200 billion. But today, I guess the sort of if you think about secondaries, it doesn't necessarily have to be a company that's worth 5 or 10 or 15 billion dollars or more. There are companies that have recently raised a funding round. I mean, Hologram is a great example. Tiger Global wrote them a fairly large check last year, which valued the company at $800+ million. So not quite there in the unicorn status, but fairly de-risked in the sense of a product market fit and institutional support with some of the who's who.
Yeah, I don't want to give away the game on secondary, so let's move over to Chris. And Chris, if you can talk about Labyrinth Capital Partners, what you guys do and what you're looking at, and how long you've been around, what was your prior experience?
You bet. Thanks, Marty. Misha kind of hit on a couple of good things. I'm looking forward to continuing a little bit on that discussion. But for my background, real quickly for the attendees and whatnot, the basic premise is this: I've been a private markets investor for over 20 years. The last 12 of which were at a prior firm where I raised and deployed about $1.5 billion. In what actually are secondary transactions, and we'll get to the split between traditional fund LP interest stuff, the other stuff we were doing there, which is really what we're doing at Labyrinth. But also in that capacity, I was on the investment committee where we were deploying in the neighborhood of $400 to $500 million a year as an LP into private equity funds and also co-investments. So the lens goes into a lot of both the qualitative aspects of what's going on in the market from a fundraising perspective, which gave me a great opportunity to meet a lot of good people to figure out how I can work with them in other capacities on their investment strategy. And right around COVID time, I decided to spin out and form Labyrinth. Labyrinth is really focused on what I call more the niche in the leading area of what's on the type of work. It's really over the last 15+ years. So we just look at, for an example, that private markets have exploded from 3 trillion to 7 trillion and going to 12, 13, 14 trillion over the next 4 to 6 years, if you believe some of the reports. what's been created are a lot of these Fisher-cracked opportunities, which are private market opportunities where you can invest capital for creating sort of liquidity for illiquid assets. So my main premise is that, which is I'm providing a liquidity solution for somebody that's holding an illiquid asset. The key is I like downside protection, which means I'm looking for the ability to find situations and working with both companies, management teams, or private equity individuals, can be either private equity or just other stakeholders in private market assets, and creating an opportunity to where we can invest our capital where I feel like I can still sleep at night with good downside protection, which is a quote, old secondary element, right? Downside protection, but actually not be pushed into an IRR initiative to where I'm trying to get cash flow back or look for quick flip type of opportunities. So what we're doing is downside protected investing and trying to make sure that we're looking for money multiple by a factor of being patient. Okay? And we're doing that in an area of the market that's sort of south of 100, really south of 50 million from a transaction side, which you can imagine has expanded in its opportunity set, which we're kind of excited about here at Labyrinth. So got two guys working with me. Cameron worked with me for about 4 years, and then Tony joined us from JP Morgan. And we're just kind of hitting the races here in 2022 after doing a small portfolio last year and kind of getting out to hopefully get several hundred million deployed here over the next few years if we get our fundraising right. So that's
and as a liquidity provider, are you providing debt, or are you buying secondaries as well?
So here's the good point about that. So you've got plenty of people in the marketplace that are providing sort of structured securities like 17 Capital, Dial, et cetera, that are doing sort of these other types of debt instrument solutions, and they're doing a terrific job in that. The catalyst for us, though, is that we're focused on money multiples. So when we're looking at structuring a security based on the risk of the transaction, Marty, it'll be a lot more difficult for us to underwrite a debt security, okay, to get an equity-like return, unless there really is an element of distress where, to be blunt, we can actually move quick enough to solve that problem and get paid, okay? So what we're not doing is a lot of, quote, debt-oriented structures. However, we are restructuring funds. We are buying into capital stacks. We are looking at opportunities to where we can get some sort of a security and or element of an interest into a special purpose vehicle that we construct that has sort of debt-like elements to protection, but provide that equity upside, okay, which is more of a function of how the market's been growing and how we can take advantage of that solution.
Great. So fantastic. Just give me a second. I'm going to pull up some more questions. So, I mean, we had a pretty amazing year in the private equity market, and secondaries have been strong for as well. How do things look for 2022?
Misha, you want to talk about what you're doing maybe on your client side, and I can kind of give a little bit more lens than what we're looking at? You're on mute, by the way.
All right, I got a 2-year-old here in the house, so trying to keep the noise levels to the minimum. Yeah, look, I think today with over and above the interest rates and this unsettling situation overseas, I think there's going to be continued demand to deploy capital, but I feel like a lot of folks will be on the sidelines until the situation resolves. I think that on the secondary front, there's definitely going to be a compression in pricing expectations, and I'm already seeing that where buyers are asking for 10, 20, 30, 40% discounts to where the names have been trading over the last couple of months. I think on the growth side of things, when we're talking primary rounds, if we're dealing with Series B plus company or growth equity round, there's also going to be a compression in pricing expectations, right? And so what we saw between 2019 to 2021, I think that issuers should be beware that if they're out there trying to get a round done, they should not expect to get the same type of terms and valuations as some of their peers and competitors may have gotten over the last couple of years. So that's kind of my 2 cents over the next 12 months.
So I can kind of take it there from more of a macro perspective on, obviously fundraising is not stopping anytime soon. You're seeing some tremendous mega funds come to market now. We obviously have heard about last year when Hellman Freeman kind of hit the big tape with their fund, and then you've got obviously on the docket for this year, Blackstone's coming out with a $30 billion, Carlyle Apollo north of 25 each, along with Advent, another host of flips that they're coming to market with those fundraisers, and they're going to probably end up hitting the bid because there is a lot of pent up demand for people to continue in private markets. So I don't see necessarily the dry powder, the commitment to private equity obviously slowing. I think it will increase. One of the key factors, though, I think one of the changes has been, and Misha talked a little bit about the secondary market, but let's just put this in context. The last several years have been more or less a seller's market because of the amount of dry powder available to invest. There, to Misha's point, and yes, global economic situations and again, demand crisis aside, which is unfortunate, obviously, what we're experiencing with Russia and Ukraine right now. But for us, chaos breeds opportunity, which is to the point of the fact that there's a premium now on liquidity for private market assets. So maybe in the first part of the year, you see that pendulum swing back, maybe back to the buyer's side of the fence where necessarily they're not overpaying. But to put some numbers on just the secondary market alone last year, it was a $130 billion market. Okay, half were in what we'll call traditional interest, which is really a mature levered beta product today. And then you've got this whole other side of the fence, which is GP ledge, which to me is more just PE opportunistic investing. But that was a $60 billion market. Now, the goal of that entire liquidity spectrum is not changing because it's predominantly a function of what's actually been employed as a primary capital investment over the last 10 to 15 years. So we see that $130 billion market last year on the secondary side is going to grow to about 150 plus this year. So I think there may be some pricing that's going to move back into the favor of the buyers, but the supply side's not slowing anytime soon because private markets are obviously robust, not just domestically, but also internationally and other areas.
Fantastic, guys. Great. So, we're talking about the geopolitical risk, et cetera, and you're talking about public markets. Is there going to be a ripple effect from the public markets into the private markets? I mean, I think we entered bear territory in one of the indexes today, right?
Yeah, short answer is absolutely. I think Misha just quoted a couple of numbers that he's already seen for resetting of expectations. And let's be clear, an easy mark to understand why there's going to be some pricing adjustment is typically, as we know, topic 820 here in the States as it relates to portfolios and private equity funds, et cetera. When we get a quarterly statement from a private equity firm and then they try to, an LP wants to sell that particular interest in that private equity firm, there's normally a quarter lag. So we're getting capital account statements that are really based on 3 or even 6 months prior valuation. So when you have a market correction here in the first quarter, people will not be paying par off of 1231 capital accounts. They will most likely look for a discount that's either in excess or equivalent to sort of the dip in the private market, because topic 820 typically means people are looking to the public markets to value their private security. So I don't know, Misha, if you want to add any more data, but you're going to see some adjustment on a lot of it.
I think you're spot on, and it certainly feels like this is very much becoming a buyer's market. And I think what we're going to start seeing is more and more sellers, trying to get liquidity. But I also feel like a lot of those discussions are going to end up either in a failed trade, or the sellers is simply going to go away and wait until the times improve, right? I mean, if you guys all remember, and Chris, you've been around the block, but going back to 2010, right? I mean, there was a massive slowdown in M&A, right? Why? Because the difference between the buyers and the sellers were fairly significant, and so sellers were again looking for the same valuations as companies were trading a year ago, but that's that's a year ago. That data is no longer relevant, right? And so the question is, can sellers get comfortable with the offers they're going to be able to get, whether it's in a secondary trade or whether it's an issue or raising around the funding, and they're in a position where a competitor may have raised capital 6 months ago, 12 months ago at 2x or 3x the valuation that they're getting today.
Great. So are there any specific sectors that you guys look at, when either you're looking at secondaries or other investments,
So here's what we do at Labyrinth, and what I try not to do, and I'll be a little bit more of a a theme for what we're trying to do. So what I try to do is de-risk by going into things that obviously are not risky. So what does that mean? That basically means I try not to buy venture risk. I'm not going in to solve problems, fund people's capital losses where I think the principal loss is actually a real possibility. So I try to stay away from anything that's associated with venture risk, which means I'm not doing biotech. I don't know how to do a phase 3 animal trial in Brazil. That's never going to happen for us. We are steering clear a little bit, even though we know the oil paths a little bit, but I'm staying away from commodities for the volatility reasons. I just think that there's too much opportunity set where we should not have to stretch for that. And the same goes for longer duration situations. So we're not really set up on infrastructure and real estate on those longer term investments what we try to do here. So that basically leaves the biggest swath of the GDP around, right? So we're looking at obviously growth equity buyout opportunities from a risk perspective, which will encompass all the major categories ranging from consumer discretionary, tech software, business services, and manufacturing industrial. So that's what we're kind of focused on here from a
Misha?
Yeah, I mean, no real industry focus, frankly. I think the way, to kind of maybe think through, and Chris, touched on this, but there are a lot of companies that are trading at a discount, right? And so, if you're a buyer and you're sitting on cash, like you have to think through, historically, how the markets have performed, following any sort of a war, whether it was Iraq war, whether it was, the Korean war, or the Afghan invasion. And typically, markets do rally, right? And so, as you're heard over and over and over again throughout your professional career, right? When there's blood on the street, you should be a buyer, right? And so, what you're seeing right now, and the uncertainty with Russia, Ukraine situation is obviously creating a very jittery market, and people don't really know what's happening. But I can take a wager, and that this is going to blow over in the next 30 days, and Russia will deal with their sanctions, and I can also make a wager that they have been preparing for any sanctions, right? And so what happens overseas in Russia is not really correlated to what is going on here, in the United States. So think about it from not what's happening today, and let me sell what I have and just sit on cash, but if you do have cash, maybe this is the time that you do want to be a buyer. And I think the real issue is inflation, right? And how are we going to deal with inflation, right? So the Fed is expecting to, I guess, raise their first hike in a couple of weeks from now, right? We're a week away from for entering March, and I think that's the real concern.
Can you guys talk a little bit about the emergence of alternative exits? I mean, people used to go to PE because there was really no other choice, but now people will do SPACs. A lot of people are listing in Australia. That's become like a really big market for fintech. There's crowdfunding. Sarah, can you talk about it?
Yeah, I can jump in a little bit because obviously you've heard about what was $60 billion market last year, which was GP-led. So Marty, to that extent, those GP-leds, which really encompass about 5 or 6 different types of transactions. But the GP-led initiative was really, it still is an idea that's been, in fact, I did my first GP-led 9 years ago. They're setting up continuation funds. They're trying to create other liquidity options for LPs, okay? Now, you've got a whole host of issues, which we don't have enough time to get into with those situations. But GPs as a fiduciary have been trying to find ways in which to create liquidity for their LPs and get exits. And continuation funds, single asset continuation funds have been mechanisms by which they've chosen to pursue that, and it will not stop, okay? They are going to use those techniques because now you have available capital to kind of go off there and do that. Warburg Pincus announced that they were doing a large $1 billion single asset continuation fund that will create a liquidity event for their fund, but want to hold on to it longer. So that market is not going away. It is growing at 60 billion last year, 30 billion the year before. That's an area of the market that's going up. You've already highlighted and you touched on SPACs in your prior panel. But I think the fundamental belief is a third of those stacks are going to be okay, a third are going to wobble, and a third are not going to be good. And I think you can start to see a lot of that investor appetite for that obviously is waning, but it's been well publicized in the press. But again, it's now another option, another tool, another arrow in the quiver of any PE manager to find liquidity. And to your point, I'm not so sure that a lot of people ultimately want to run to other, geographic markets just to get a public listing, thinking that that's going to be the best way to get liquidity. You still need support. And you still need to make sure you know how you're going to get in and out of that security. So, Misha's on the advisory side more. He knows that M&A is coming. Debt is around and available. It is cheap, still cheap, despite the rising interest rates compared to years past. So I wouldn't be surprised that we're not going to stop seeing more M&A liquidity, or there are options such as GP-LEDs or anything else that a GP can do to basically figure out how to basically get chips off the table and create cash flow back to their investors. But I'll let Misha chime in on what he may be seeing on the advisory side.
Yeah, I can also, I guess, briefly touch on SPACs, right? And we all saw that, SPACs have underwhelmingly, underperformed, right? Overwhelmingly underperformed. A lot of SPAC deals have been, unfortunately, a bad turnout for many companies. And, I think, while the public markets were hot, right, a lot of investors were happy to just throw money because it was hot, right? It was, capital rides took place, and guess what? The market rallied, right? Negative things happened, the market rallies, right? But those days are kind of over. And so, I think what you're going to again start seeing is and I keep going back to this, is you are going to start seeing more and more secondary trades as investors do need to get some liquidity. Companies will continue staying private, right? To Chris's point, there's been, the Blackstones of the world, the Tomoxis of the world, they're out there raising, multi-billion-dollar funds. And so there is an abundance of private capital out there. And whether it's an M&A trade, whether it's, a secondary transaction, going public and whether it's a SPAC or a direct or an IPO deal, was a great way to get that liquidity. But now it feels like, that option is sort of closing and has already closed for many companies. So we're, going to see an uptick in M&A deals and just continue funding private companies with private capital.
Chris?
Yeah, I mean, he touched on it. I already hit it. I'm not really, I already mentioned, Marty, what I thought. I mean, there's plenty of liquidity out there. Private markets are going to have plenty of money to go around. The question at the end of the day for any LP coming into private equities is needs to make sure that they understand that the GP that they're going with, that they're raising a larger fund size, that they actually know how to deploy that effectively, that they stay within their lanes, that actually, if they were winners before, are they staying in the same sort of strategy that can make them winners before? I think there's a couple of outliers on folks that have actually raised significant amount of money way beyond what they did maybe 8, 9, 10 years ago, but have been extremely successful with their team on being able to distribute and deploy more capital in a very effective and return way. So private markets has plenty of money, Marty.
Yep. Yeah, that's interesting. So I have time for like one more question, and you can either take the question I'm going to ask you or decide to answer a different question that you want to ask yourself. But since I think that Chris is strapped for time, Chris, is there anything you want to say? I have a question on secondaries and trophy assets. But
Go
Chris,
for it. Yeah, go for it.
So, what we found is that as all these companies announced they were going public, that were unicorns. So getting back to Misha's point, there's more 1,000 plus unicorns, 7 unicorns a day are being produced, and only so many companies can go public in any year. So there's obviously this tremendous line. But as people announce they're going to go public, you see that there's a kind of a rush for the doors of people who want to get in on that offering. Just to say they bought it before IPO or whatever. Can you talk about that, trophy effect, or are you seeing that as much as I see it, or what?
So let me just,
Chris.
Yeah, let me just mention real quickly 2 things on that. Number one is you have to understand what's going to be happening as it relates as a function of the private markets moving in with the capital appreciation that's going to happen. You have new players that are coming into the market in a significant way. Retail investors now are coming in a significant way to alternatives. Okay, so Marty, that's feeding a little bit about how all these retail guys only want to basically get access to these unicorns or these hot names, especially in the IPO market. Now, obviously, a lot of that has been restricted. However, now there are people that are disintermediating that access point. Okay, so there are going to be more public companies coming to market. There will be more access points. iCapital has done a great job, Lawrence and Nick, doing what they've done to actually put people like Fidelity and a few others onto their platform. They are giving access to, those plans and those individuals to get on to interesting opportunities through the managers in which they put on. But to your point, We have Fidelity, Wilshire, all the usual suspects, even Tiger, Misha mentioned Tiger, but folks that come into these Series D, Series E pre-IPO round, right? That are typically on average 6 months or 18 months in advance of an IPO actually occurring. That's a difficult point to access those types of rounds as an individual retail investor. However, if you've been an investor or has some access points to those types of situations to the managers that had been invested previously, then maybe you get into those situations. But I think the market has woken up. You've gone through the unicorn stuff. People have choked on the SPACs, okay, on these high-flying ideas of whatever was basically being put to work. And you're getting back to realism. People want to see real companies doing real work with some visibility to cash flow positive. Okay, so the IPO market's not going to go away. The access to these things is still there. The question is, what do you pay for it? Okay, what am I actually paying for? There are a lot of people that have gotten burned by paying up in some of those unicorns and now are coming down. We don't have to talk about Peloton. We don't have to talk about Uber. And well publicized. So I still say buyer beware, right? Every time there's everybody's hot to trot onto something, be careful, because sometimes you can actually see the balloon being pumped up a little bit to choose that I'm going to suddenly pay a valuation that's 2x over what it was 12 months ago. So IPOs aren't going away. The rounds aren't going away. But I still think people need to still take their medicine a little bit and have a sense of reality. Why am I paying X valuation on this particular company when their public comparables are 20% lower than that?
Fantastic. I know you got another meeting, Chris, so thanks so much for participating. Misha, do you want to give it a shot?
Yeah, I got a couple of thoughts I wanted to share. So as Chris said, right, IPO market is not going to go away, but it's certainly going to slow down, right? Whereas, when Airbnb went public and DoorDash went public and, people went crazy over these names and the stocks, did run up, right? But at the same time, you've seen the Robinhoods of the world, who have been, unfortunately destroyed, right? And people lost a lot of money. And so what I think is also going to happen is, as companies evaluate their going forward, plans, I think people need to extend their expectations and not think about these high flyers as, this company is going to go public in the next 6 months and we're going to have this massive run up like DoorDash did, and I'm going to make a boatload of money in the next 6 months. I think people need to be a little more patient, right? And to the point of valuations is, while some of these valuations may seem fairly high, well, look at, a company like Epic Games, right? If, a couple of years ago, if I was to, Marty, if I offered you Epic Games 2-3 years ago, and I'm just going to make up a random number, the company is worth $15 billion. And you said to me, Misha, $15 billion, what the hell am I going to do with a company that's worth $15 billion? How much more room does it have to grow? Well, guess what? In that term, you're up 3x, right? Again, it's about being patient, right? And not expecting a quick flip with an IPO, because that's where the market has been over the last